All right. So when you start a business, whether you're providing a service, selling candles from your basement, or whatever it is, when you start to make income that is not from an employer, you are by default a sole proprietor. The sole proprietor is the most simple form of business structure and provides no asset protection. So you can go start making money without really doing anything formal, and by default, you are a sole proprietorship. When you file your tax return at the end of the year, everybody files a 1040, you will simply include your business income right within your sole proprietor, right within your tax return. So the sole proprietor, the federal government sees you and your business as one and the same when you are a sole proprietor. There is no asset protection. Again, it sees you as one and the same. So back about in the 60s, you could be a sole proprietor or you could set yourself up as a C Corp. And this allowed you to develop a separate entity for your business, separate from yourself, and provided the asset protection. So your personal assets are not at risk. Now, the C Corp specifically, if you are a small business owner and you are in a C Corp, I would recommend that you find someone locally to make sure that it is the structure that you should be in. Okay. In general, if you are going public or you are going to have more than 100 shareholders is the reason you would get yourself into a C Corp, but it comes with very high taxes and a tax structure that you don't want to get yourself into as a small business owner. All right. So if you are a small business, especially a solopreneur, or less than 100 shareholders in your business and you are a C Corp, please seek advice to make sure you're structured appropriately. Okay. So back in the 60s, that's all you could do. You could either not have the asset protection or you could structure yourself as a C Corp. Fast forward to about the 70s and the states started adopting what is called LLCs or limited liability corporations, limited liability companies, same thing. And this structure allowed people to provide, to get asset protection for their personal assets, different from their business without being structured as a C Corp. Now, the thing to understand here that I work with business owners every day that there's so much misinformation and misunderstanding around the LLC. And the thing that is important to understand here is that the LLC is a state formation. Okay, when you get an LLC, you're going to go to your state's Secretary of State and structure your business as a separate entity. Where the confusion comes in is I ask people every day, people call me all the time for services. I say, how are you taxed? They say, well, I'm an LLC. Excellent, but how are you taxed? Well, I'm an LLC. An LLC is a state formation only and has nothing to do with how you're taxed. It provides asset protection, but if you get an LLC and don't do anything else, you are by default taxed as a sole proprietor. Okay, sole proprietors pay 15.3% self-employment tax on their profits. Okay, profits. You got top line sales minus all of your expenses gives you your net profits. Whatever your net profit is, you will pay, in addition to income tax, 15.3% self-employment tax. Okay, now if you are a sole owner. If you happen to, I do not have partnership up on the screen here, but if there is more than one owner, you are then a partnership and the same tax rules apply. Okay, you're going to file a separate return as a partnership, but you're still subject to the 15.3% self-employment tax. Okay, so then the government came up with the S corporation. This is a tax status that still provides the asset protection because you need an LLC to have an S corp. Okay, you can't just file an S corp. You've got to have an LLC in your state, and then you can file an election to be an S corp. And what that does is that changes your tax status. Okay, so now the federal government doesn't see you as one and the same. You have a separate entity, and you don't have to pay self-employment tax. Okay, so under the S Corp, you now pay yourself a W-2, just as you had a job at McDonald's. right? In addition, there are all kinds of ways that small business owners can maximize tax deductions through the S corporation. It is a beautiful structure. The key is, everybody asks, well, then why am I not an S corp out of the gate? Okay. The thing about the S corp is it requires additional accounting measures, and until you get to a net profit of about $30K consistently, it is difficult to maintain the S corp structure because you need to pay yourself W-2 wages, which in turn will require you to pay payroll taxes. Okay. So getting yourself into an S corp too soon can hurt a small business because of the tax and formality requirements of it. Okay. But when you are ready, it will save a small business owner tens of thousands of dollars out of the gate and ultimately in the life of your business. All right. So the question is, should you be an LLC? And I think this is where really, when you sit down today, I want to give you some homework, some to-dos to think about so that we can get to the next part of this series. Really want to look at how you should be structured and if that LLC is appropriate for you. Okay. So what considerations should we be looking at?